Your business isn't broke. It's just leaking money in all the wrong places. So for those still not living a 3.3 life and following the 3.3 rule, it's likely you're showing up to work early, skipping lunches, answering emails late into the evening, yet your bank account feels like it's lacking a little thing called cash. You're busy, yes, but wealthy someday. According to the US Chamber of Commerce, 82% of businesses fail because they have cash flow issues. Can you imagine being the other 18% that doesn't have a cash flow issue, but your business still fails? Check out my other videos on systems and team member processes to help with those. This video is focused on creating a financial roadmap to help with cash flow problems. We call these roadmaps because the map of the location shows you all the roads that exist in the area so that you can determine how to get from where you are to where you want to go. Some of you may not know this because you're not old enough, but before GPS, you would print off directions from the internet. Or before that, you would have bought a book of maps and you had it in your car. So whether you want to call this a financial roadmap or your financial GPS, I don't really care. The metaphor plays out the same way regardless. You are here and you want to go there. And the map is the tool that helps you do that. So step one is to have clean accounting. The you are here concept is going to work better when you have accurate financial data. Without it, you could find yourself following the GPS instructions right into a lake, which did actually happen in the early days of GPS. Bad data is bad for decision making. If you want to fix your cash flow problems, you have to be committed to doing the work. The typical next step you'd be told to do is create a budget, which is often the process of looking at the last 12 months of financials and determining what you made and what you spent on average, and then assume you'll do that for the next 12 months. This method is not effective. And frankly, one of the reasons most business owners, the non-accountant business owners, don't like budgeting and act like they don't understand it. It's not that it's complicated and they don't understand it. It's their subconscious telling them it doesn't make sense to do that. If I have cash flow problems, this old and tired method of forecasting is just going to budget more cash flow problems in the future. Another way to think about this is, who cares what you did, especially if you aren't in love with your results? The question we want to answer is, what do you want to do? That is what you plan. This is not going to be our approach. We're going to look at historical numbers, but it has to be done in the right context. Our 4-step framework is quality accounting, forecast goals into financials, cash flow analysis, create dashboards. Now, I already mentioned the need for quality accounting, and I've done a video you can watch on this channel on the 6 things that make up quality accounting if you want to have more specifics. I'm also happy to make any recommendations if you want help with that, so message me and I can connect you with accountants. Step 2 is to forecast your goals into financials. And so we want to start with revenue. Think about your revenue goals between now and the end of the year. To do that, I want you to list all your services or products you currently sell or want to sell. If you have any new services you're offering, when will those services be ready to sell? Maybe I want to add a monthly group coaching call, but I know I need 2 months before that works with my schedule. I wouldn't include that new revenue on my forecast this month. I'd start putting it in for 2 months out. Also, I'm probably going to ramp up members into that group, so I'm not likely going to come out of the gate with the full group. So I want to be realistic in my forecast to match a true pace of revenue growth for this new service. Another revenue thing to consider is if you are making changes to any of your existing services, any pricing changes, either up or down. And will those pricing changes result in more clients or less clients? After that, we transition to thinking about your existing services. Are you stopping any of them? Did you realize you have a service that isn't making you money, or it's too involved to offer, or you simply don't enjoy it anymore, so you're just going to cut it? As you answer those questions, you should be plugging in revenue forecast broken down by month. I use an Excel file for this, Google Sheets. Then next, add the services that you aren't changing. So your past historic data should be reliable to use for those numbers, but make sure you consider, does your income occur pretty even throughout the year, or do you have seasons of high sales then low sales, in which case you wouldn't just use a straight across average? With your revenue numbers in, which include services you've offered and are still offering, you've removed services you are no longer offering, and you've included new services you're starting. Let's just pause for a second and ask ourselves, how realistic are my numbers? I've yet to meet a business owner that is not optimistic about revenue growth. We just want to make sure we're being pragmatic and realistic here. One way to check this is by asking ourselves, how many units or clients need to be sold to hit those numbers? Have I ever sold that much before? With your revenue in place, broken out by month, we now want to forecast our expenses. And this is not taking the average amount we spent each month and plugging it in. Don't do that. Instead, let's start by looking at the direct and specific expenses you have based on the revenue. What do I mean by that? Starting with new revenue streams, what are your new expenses going to be that are associated with that new revenue? Are you hiring people to offer it? That'd be an expense. Are you giving raises to existing people to offer it? And that's a new expense. Will there be new bonuses because of it? That's a new expense. What are my new labor related expenses because I'm not offering this new service revenue stream right now, but I will be? Are there any software or tools that I have to pay for in order to offer the new service? So again, any new expenses I will have because of the new revenue, I want to include that here. Then we look at the existing services we're continuing to offer. What does it cost me to deliver those services? Not what has it been costing me. I want you to rethink through all the activities that go into your offering and tie expenses to those activities. Then we look at all the other expenses that are not directly related to providing the services or products. Now, my preferred way to do this is to look at my expenses from last year and ask myself, does this expense help me get clients or keep clients? I learned those questions from Keith Cunningham. If it isn't helping me with either of those, why do I have that expense? Don't include it in your forecast, and then make sure you cancel the actual payment. What I just described is not a quick process. You can likely get it done within a day, but it's definitely not a 15-minute easy peasy get her done process. But at the end of it, if you take the time, you should have a pretty amazing forecasted financial statement throughout the rest of the year. This video is an accountant's dream and most business owners' nightmare. If you've stuck it out this long, thank you. I really hope this serves you. I can make more detailed videos on the last 2 steps of my process, but I fear that if I keep going, you'll want my head on a pike. Once you have your forecasted financials, you want to make sure it shows that you're profitable. You'll also be able to use those financials to forecast out cash flow. We love the Profit First method as our cash flow management system, and we do a cash flow analysis similar to Profit First method, and that shows us where the cash would be going. And if after doing all that, it still shows we aren't profitable, I need to go back and relook at my goals and consider any changes necessary to get me to profitability and a healthy forecasted cash flow. Because if it doesn't look good on paper, I promise you in real life, it will not magically be better than what you forecasted. Assuming now that your cash flow analysis says things look good for you, then you want to create a dashboard, which is just a fancy way to say some sort of report you can look at to track your progress toward your goals. At that point, you've completed the 4 steps and you have a really thorough roadmap that helps you track your journey to your financial destination. We have created a free business efficiency assessment. It's a free quiz. One part of that assessment is focused on helping you understand where you are at with your cash flow. And then based on your answers, we give you some suggestions on things you can do to improve it. So click the link to take it. Great investment of your time. And remember, profit is a choice. Have the courage and wisdom to choose it.